I started investing when I was only 11 years old. For some people that may seem very early, but at that time I was already curious about how money worked. I wanted to figure out how to make money grow, like a plant that needs to be nurtured to bear fruit. But before I actually started, I spent a lot of time procrastinating. When I was 7, 8, and 9 years old, I was just thinking about what to do, but never took any action. I guess I was a little scared to start and not know how to do it right. Finally, when I turned 11, I gathered the courage and bought my first stock, which is like buying a small part of a company. That was a huge step for me and marked the beginning of my journey into the world of investing. At that moment, I didn't really know what I was doing, but I was excited to learn. As soon as I bought my first stock, I started trying different things. It was like I was conducting experiments to figure out the best way to make money from stocks. I tried things like timing the market, which means trying to guess the best moment to buy and sell stocks. And I even created charts, drawing lines to show how stock prices went up and down. I thought that if I stared at those charts long enough, I could discover the secret to success. I tested some pretty crazy ideas, but you know what? Even though I didn't make any money from them, it was a lot of fun. I kept doing this until I was 19, and during that time, I read every book I could find about investing at the public library. It was like I was on a treasure hunt, but instead of searching for gold, I was searching for knowledge. I found it all fascinating, but the problem was that I still didn't have a clear strategy. I was just trying to figure out how things worked without really understanding what made a stock good or bad. I thought that if I looked closely enough at the charts and found small signals, like hidden clues, I could predict what a stock would do next. It was like trying to solve a very difficult puzzle. Sometimes I even turned the chart upside down, thinking that maybe this would give me a new perspective and help me see something I had missed. But as you can imagine, that never worked. Although it was a funny way to try to learn, it wasn't practical. In fact, many people at that time were doing the same thing. They also believed that if they paid close attention to the charts, they could figure out what would happen with the stocks. I thought, if everyone is doing this, it must be the right way. But over time, I realized that this approach wasn't the best way to invest. Then, in 1949, when I was 19, something incredible happened. I read a book called The Intelligent Investor, written by a man named Ben Graham. This book completely changed the way I thought about investing. Before reading this book, I had never heard of Ben Graham, but by the time I finished it, I realized he had some really important ideas about how to invest. There are 2 chapters in this book that are especially valuable, and they changed the way I looked at the stock market forever. They taught me 3 very important lessons that I still use today. The funny thing is that these lessons are so simple that at first I couldn't understand how they could be so important. But after putting them into practice, I realized that these basic ideas make all the difference. The first lesson I learned from Ben Graham's book was that a stock is like a piece of a company. When you buy a stock, you're not just buying a piece of paper or something abstract. You're buying a real part of a company, and that company has employees, products, and customers. So when you buy a stock, you need to think, is this a good company? Because if the company is good, the stock will likely be valuable. If the company has problems, the stock will too. This means that instead of trying to guess what will happen with the stock price by looking at charts, what you should really do is try to understand how the company works. I learned that the important thing is to evaluate the business itself. If the business is strong, the stock will have value in the long run. The second lesson I learned from Ben Graham was about how to deal with changes in stock prices. Stock prices go up and down all the time, like a roller coaster. This can make a lot of people nervous, and they end up making bad decisions. They buy stocks when the price is high because everyone is excited, and they sell when the price drops because they're afraid of losing money. But this is not a good strategy. In Chapter 8 of the book, Ben Graham talks about something called Mr. Market, which is a fun way to understand the stock market. Mr. Market is like a business partner who comes to you every day and says, "Today, I'm willing to buy your stocks for X dollars, or I can sell mine for Y dollars." The funny thing is that Mr. Market is very temperamental. Sometimes he's super excited and offers a high price for your stocks. Other times he's sad and offers a very low price. The secret is not to be swayed by his emotions. When Mr. Market is in a bad mood and offers a low price, that's when you can find good buying opportunities. And when he's too excited and offers a high price, maybe it's a good time to sell, if it makes sense for you. This was one of the most important things I learned. The stock market isn't there to tell you what to do. It's there to serve you. If you learn to watch the market and wait for the right moments, you can make great deals. Sometimes the value of a stock can vary a lot throughout the year. For example, a company might have a stock price that ranges from $10 to $20 in the same year, even though the company itself hasn't changed that much. This happens because the market is very emotional, and the stock price reflects the mood of the people buying and selling. But the real value of the company doesn't change that quickly. What changes is the market's perception. So instead of letting the market influence you, you should use these fluctuations to your advantage. Another important thing I learned, and something that many people have trouble understanding, is that a stock doesn't know you own it. This may sound funny, but it's true. When you buy a stock in a company like Berkshire Hathaway, the stock itself doesn't know who you are. The company doesn't even know you exist, unless you own a lot of shares. Even so, you might get emotionally attached to that stock, as if it were your friend. But that's not a good way to think. Stocks don't have feelings, but we humans do, and sometimes those feelings cause us to make the wrong decisions. That's why you need to remember that a stock is just part of a business. If the business is good, the stock will be a good investment. If the business is bad, the stock won't be a good choice, no matter how much you like it. What really matters is the quality of the company, not the price of the stock itself. The third important lesson Ben Graham taught is about the margin of safety. This might sound complicated, but it's actually a simple idea. Imagine you're driving a truck that weighs 9,800 pounds, and you come to a bridge with a sign that says the maximum capacity is 10,000 pounds. Would you cross the bridge? It might not be a good idea because even though your truck is under the limit, it's very close. It's safer to find another bridge with a larger margin. In the world of investing, the margin of safety works the same way. You should always have a margin of safety when you invest, which means not buying stocks when they are at their highest price. Wait until the price is well below the actual value of the company. That way, even if something goes wrong, you'll still have a margin of safety that protects your money. In the stock market, no one can predict the future with certainty. There are many factors that can influence the price of a stock, and it's impossible to control all of them. That's why it's essential to have a margin of safety in all your investments. This means waiting until you find a clear opportunity when the stocks are being sold for a price much lower than what they're really worth. When you find a stock like that, you can invest with confidence, knowing that even if something goes wrong, you're protected by your margin of safety. Now, when we're talking about large amounts of money, like $1 million, for example, the most important thing is to understand the business you're investing in. Let's imagine someone gave you $1 million, and you have just 1 week to choose 3 companies in the state of Tennessee to invest in. What would you do? You would spend that time analyzing the companies you already know, the ones you've heard of, or that have a good reputation. Additionally, you'd also look for companies that have competent leaders, people who know what they're doing, and whom you trust. What you're really looking for are companies with a lasting competitive advantage. This means these companies have something special, something that sets them apart from the others and makes them successful for a long time. A good example of this is Coca-Cola. Coca-Cola is such a strong and well-known brand worldwide that even if the company spent billions of dollars on advertising, it wouldn't change its image much. People already love Coca-Cola, and that's something very valuable. That's the competitive advantage you want to find in a company that has a product or brand so strong that people choose it, even if there are other options. Besides finding companies with a competitive advantage, you also want to make sure the business is run by honest and competent people. This is very important. Sometimes a company can have a great product, but if it's poorly managed, it can end up having problems. But ideally, you want to find companies that are so good that even if an incompetent manager takes over, they still do well. Peter Lynch, one of the most famous investors in the world, once said, "Buy a business so good that even an idiot could run it, because one day that will happen." He meant that eventually all companies might go through difficult times with bad leaders, but the best companies can overcome those moments. And that's the type of company you want to find. Recently, someone asked me, what will happen to Berkshire Hathaway when you can no longer lead it? And I replied, half-jokingly, Berkshire is so well structured that even if I go crazy, it will still run well. That's the kind of company you want to have. A company so strong and well managed that it can keep growing even if it goes through tough times. Therefore, when you're choosing companies to invest in, you should look for three things: a lasting competitive advantage, competent and honest management, and a price that makes sense. If you can get these three things, you're on the right path to long-term success. Throughout my journey in the world of investing, I've learned that success doesn't come from magic formulas or trying to guess what the market will do next. It comes from deeply understanding businesses, having patience, and knowing when to act. The lessons from Ben Graham, such as understanding that a stock is part of a business, using the margin of safety, and not being swayed by market fluctuations, have shaped my way of investing and can help anyone become a more aware and prepared investor. Investing doesn't have to be complicated. With a bit of study and a calm, strategic approach, it's possible to make wise decisions that will yield results in the long run. Always remember to evaluate the business behind the stocks. Look for companies with lasting competitive advantages and trust competent and honest managers. And above all, be patient. The stock market may be a roller coaster, but with the right choices, you'll be well prepared for the ride. If you've made it to the end of the video, comment, "I stayed until the end." When I see that comment, I'll be happy to respond because I'll know you're on the right path to becoming a millionaire soon and that you stayed with me until the end. And now, on your screen, there's an incredible video I've prepared especially for you. I'm sure it will add a lot of value to you, so click on it and go watch it right now. Do it for yourself and your future. See you soon.